Hello, the Chancellor has not long just sat down. I'm Martin Lewis from MoneySavingExpert.com, and this is my instant budget reaction. I'm going to be talking about national insurance contributions, the minimum wage, stamp duty changes, inheritance tax changes, taxes, carers allowance, child benefit, capital gains changes, BIA and more. Look, I need to be straight. The main stuff in this budget was about a big spending boost for the NHS and school buildings. It was about the economy, and it was about changes to the way the nation invests. That's macroeconomic. It's not my bag. I'm focusing on the personal and consumer finance impact of the budget. This is my instant reaction. 8 o'clock ITV Thursday night. I've got an hour-long show. You can watch that then for the full considered reaction. So let's go through it. The big change, the big announcement, raising a lot of money for the revenue, is there's going to be an increase on the national insurance cost to employers. National insurance employees paid went down 2% in the last couple of years. Instead of putting that up, it's basically been shifted onto employers. So the rate of national insurance that employers pay going up from 13.8 to 15%. And crucially, they will start paying that on an employee's earnings of just £5,000 a year rather than £9,100 a year as they do right now. So that is a big hit to many employers, although smaller employers will see an increase in the allowance they get, so they now won't have to pay national insurance on their first £10,500 a year, which will save many smaller employers. But I wanted to bring this out because you need to understand. Let's just look at that change in the allowance. Currently, you start paying as an employer national insurance at £9,100. If you drop that to £5,000 at a 15% rate, just on that difference alone, that's £615 more a year per employee. Something is going to have to pay for that. It'll either come out of companies' profits, increased cost to consumers, or reduced salary and benefits in future for employees. So while it is not a direct cost on consumers, it probably will have some knock-on effects on consumers and workers in the future. Next, to counter that to an extent, the minimum wage is going up next April. For those aged over 21, it's going up from £11.44 an hour to £12.21 an hour. That is above inflation, 6.7% rise. For those aged 18 to 20, it's going up from £8.60 an hour to £10 an hour. A much bigger rise there because they're trying to make it in the future. Everybody over the 18 will have the same minimum wage. A note from me, if you're on the minimum wage, make sure this happens next April. Some employers don't do it automatically. That falls foul of the law, but sometimes it doesn't happen. Also, if you're on the minimum wage, there are reasons you might not be getting the full minimum wage. They might not be factoring in the cost of your uniform. They might not be including all your work hours. We have a full guide on Money Saving Expert that anyone on minimum wage should read, and its ways are effectively being diddled on your minimum wage, and you shouldn't be. Stamp duty. There was something announced in the budget and something not announced in the budget that's happening. In the budget, it was announced that if you're buying a second home, the extra stamp duty you pay on top of the normal stamp duty is rising from 3 percentage points to 5 percentage points. So from tomorrow that happens, anyone buying a second home is going to pay much more stamp duty. But what wasn't mentioned but is in the documentation is the thresholds and when you start paying stamp duty were due to drop next April, and that is being continued. So from April next year, you will start paying stamp duty on a property that costs £125,000 or more. Currently, it's £250,000 or more. So a lot more people will be paying stamp duty. If you're a first-time buyer, you will be paying stamp duty on a property that costs £300,000 or more. Currently, it's £425,000 or more. So big change to stamp duty there. Inheritance tax is next. Unchanged, but the thresholds are frozen. So if you won't pay inheritance tax on an estate that has less than £325,000 in it, and that's going to continue that threshold to 2030, or it actually goes £500,000 if you're also passing to your descendants your property as well. What is a change to come is that inheritance tax will apply to pensions from 2027. Currently, if you pass on your pension pot and you're aged under 75, there's no tax on it. Age over 75, income tax is paid on it. From 2027, inheritance tax will be paid. Exactly how, when, where, there's a consultation happening. We don't know yet. I will be digging more into that, but that is quite a change for those certainly with substantial pensions. While we're on tax, fiscal drag is here to stay. So what is that? That's the fact that the amount you pay income tax and the amount you pay basic rate and higher rate income tax has been frozen. So even though earnings are going up with the thresholds frozen. Effectively, people are paying more tax each year, which is a way the Exchequer gets more money. It was due to be frozen until 2028. It was thought the Chancellor would extend that to 2030. She didn't. It's now only frozen to 2028. In reality, though, each year for the next few years, as inflation and earnings go up, everyone will effectively be paying more tax. And to be honest, the extending it from 2028 to 2030 would have only been a paper change anyway, because she might have changed her mind in a year or two. There's lots of budgets before then. But that was sort of the rabbit out of the hat. It says something, you can see it's a tax rising budget when the rabbit out of the hat is not doing something that was predicted to be bad, rather than actually throwing in something that's good. Carers allowance, something I've campaigned a lot on. This is for carers who care for a close family member or somebody over 35 hours a week. There's going to be a slight rise in the amount you get from £81.90 to £83.29 a week. But the real key is the earnings threshold is increasing from £151 a week to £196 a week. So that means you will, from next April, be able to earn up to £196 a week and still get your carers allowance. But you go a penny over that, and they take it off you. It's called a cliff edge. It shouldn't happen. I've campaigned about it. The Chancellor acknowledged it was unfair, and they are looking into what they can do. But at the moment, there is no change to that cliff edge. Next, we have a confirmed rise in the state pension of 4.1%. So the new pension, full pension, going up from £221.20 to £230.45. Though most state pensioners are on the old pension, which is going up from £169.50 to, by my calculations, because it wasn't in the document, £176.45 a week. But those are only if you get the full pension. Pension credit is going up by 4.1% too. And the threshold by which you can get pension credit from next April, you get it as a single person on annual earnings below around 11,400. It'll be below around 11,800. Benefits are going up by 1.7% from next April, but they are bringing in the Conservatives' work capability assessment to try and get people off benefits and into work, which I know there's been quite a lot of disquiet about. And they're also starting to look at speeding up managed migration, moving more people more quickly onto universal credit. Again, more details to check on that. Child benefit now, something else I've campaigned on and I'm disappointed about. The last Chancellor said they were going to move it to an assessment based on household income rather than the highest earner's income. They've said, buried in the detail of today's budget, it wasn't mentioned, they are not going to do that. It will still be based on the highest earner's income. Now, in the last budget, Jeremy Hunt increased the threshold, so you start to lose child benefit now at 60,000, it was 50,000, and you lose it totally at 80,000, it was 60,000. That is staying, but this lack of change on the higher income child benefit charge, so it's not going to be household, still means you could have two neighbours, both relatively high earners, who get it, and next door you've got a single earner family where they get just over the threshold and they don't get it at all, which would be unfair. They are making some changes there. Employers will be able to pay via the tax code, and self-assessment will be automatically filled for you. Capital gains is going up from today. Second homes is staying the same, but the basic rate of capital gains is going up from 10 to 18% on shares and other assets, and 20% to 24% if you're a higher rate taxpayer. The capital gains tax allowance is staying the same at £3,000. And I'm going to have to stop there because social media videos are only allowed to be up to 10 minutes on most platforms. So I haven't had time to talk about no rise in fuel duty or a penny off a pint in a pub, or the changes coming to Help to Save, or private school costs. Confirmed that VAT will come on next January and business rates for private schools will go up in April. I haven't been able to talk about the fact they haven't made announcements about lifetime ISAs or mortgage prisoners or WASPI compensation or student maintenance or mitigation for winter fuel payments. But I'll be doing those on social media, doing those on my show tomorrow, and it will all be on moneysavingexpert.com. Hope this worked. Bye-bye.